Asset liability management as a practice was first established in banks to primarily manage the impact of interest rate movements on banks' net interest income. NII, as it's called, however, derives from a combination of changes in interest rates as well as the structural mismatches in the balance sheet. Thus, the scope of ALM gradually evolved over the years to incorporate wide-ranging practices covering balance sheet planning, product structuring, liquidity management, funding management, transfer pricing, and capital management, thereby acquiring a broader terminology called balance sheet management. The BSM practice witnessed tectonic shifts since the onset of the global financial crisis in 2008. It exposed lax practices around managing asset liability mismatches and liquidity levels in the balance sheet across the globe, and in particular the US and European markets. Regulators responded with the Basel III reforms that prescribed stronger oversight, higher thresholds, standardized approaches of measuring and monitoring various risks on the balance sheet. The regulations focused on improving the quality of capital, liquidity, funding, and interest rate mismatches with more granular and frequent disclosure. More importantly, given the dynamic nature of the balance sheet and the volatility prevailing in the markets, regulators saw fit to recommend banks to assess all risks on the balance sheet in an integrated manner. This is to incorporate correlations between various risk categories under a wide range of stress scenarios. This necessitated banks to adopt a more dynamic forward-looking approach rather than the prevailing static or historical approaches. As a result, banks have increasingly spent more time and resources to comply with these regulations rather than on improving and optimizing their business. As these new regulations gradually come into force, banks now have to look at adjusting their balance sheet positions and strategic plans to optimize for new regulatory and market regimes. This entails the bank to first get a 360-degree view of their risk-return positions on their balance sheet and understand and predict the behavior of their customers through behavioral models. This will essentially form the basis for establishing an integrated balance sheet model that reflects the reality of the bank. It will further require banks to break down their strategic plans and goals into granular balance sheet projections and develop various realistic market scenarios to understand the impact on its risk-return elements. Aptivaa offers a comprehensive set of advisory and cutting-edge analytics solutions to help our clients achieve these objectives.